This everything, everywhere, everyone property boom, I'm going to call it here, it's over.
Economy is probably still tracking that like 5 out of 10, 4 out of 10, like just barely passing.
This is rapid growth rates that are happening on the ground. So we are in the middle of booms in these cities. Like,
We were really waiting for these rate cuts to come through. So we've had 3, probably a little bit less easing than maybe expected.
it's not the same as you just throw a dart anywhere in Australia and it's going to make you fly.
There isn't much of a housing boom, but there's an economic boom.
"2025, the year that was." Here we're going to recap everything that happened in 2025. It's been an absolutely massive year for property investors. We have had the everything, everywhere, everyone property boom, and that has been the story of 2025. But there's also been rate cuts that's triggered a re-acceleration in different markets. We have had 2 sort of periods that have begun the year and ended the year, and there's been a big change in lending in the back quarter of the year too. In this episode, we're going to recap the year that was 2025, the lessons of it, and everything we've picked up city by city as well. Curtis, my man, how are you?
Going good. I think, yeah, there's been a lot, it feels like there's been a lot of changes even in the last just like 6 weeks, 2 months towards the end of the year that have kind of changed the dial a little bit compared to how we were tracking. So
Yeah, for sure, man.
good to run through it.
Yeah, we began the year with a 4.35% cash rate, thinking about when is the rate cut coming. I think in and around January, we knew it was coming soon, but we didn't know exactly when. There's been 3 rate cuts. So let's start with theme number 1, the rate cutting cycle and the economy at large as well, and what's happened there. Do you want to run through what has happened in 2025 with the rate cutting cycle and the economy and what it's meant?
Yeah, so we've had the 3 rate cuts, like you mentioned, and they were long awaited. As anyone that's been a long-term listener of this podcast will know, towards the very start of the year and even the back end of last year, we were really waiting for these rate cuts to come through. So we've had 3, probably a little bit less easing than maybe expected, particularly saying that now in December. So a little bit of easing, 3 rate cuts, but not as drastic a change in the cash rate as could have been, like as we could have predicted in Jan. The economic performance has been a little mixed. I would say fairly weak for the majority of 2025. Some of the indicators over the last month are looking a little stronger. Labor market, maybe not so much, but yeah, economy is probably still tracking that like 5 out of 10, 4 out of 10, like just barely passing kind of mark,
man.
I reckon.
Brutal.
As it's been sitting there.
I like brutal, Curtis.
Is that brutal?
A little bit brutal.
5 out of 10's a pass, no?
You said 4 out of 10. You were like earring to 49 out of 50 or 49 out of 100.
All right, 51 then, if that makes you feel better.
No, I like brutal, Curtis. It's hard. No, I agree with you. There's a couple things that I've picked up there. So the main thing is that the rate cutting cycle hasn't had so much of a powerful impact on the economy because the economy has slowed down. Clearly, unemployment is trending up and inflation is rising too far again. Maybe it has had an impact on the economy, but largely it's really flowed through to the housing market like bonkers. The typical story. You cut rates and everyone goes out there and buys a house or starts being like, I want an investment property. And that has been the big theme of 2025. It's just like the power, 3 rate cuts and still being in restrictive interest rate settings because the RBA have said it out loud that interest rates should be slowing the economy down. We're still in restrictive interest rate settings, but everyone under the sun is just like, can I buy an investment property? Can I buy property? Demand has absolutely shot up for property this year as well. Like, wild.
Yeah, and if you're the RBA, it's probably a little bit worst of both worlds. Like, they don't really target house prices, and their preference would probably be that there isn't much of a housing boom, but there's an economic boom, and they haven't had much of an impact on the real economy. But they have driven asset values up.
Yeah, it's like, oops. Yeah. That's not what we wanted. Inflation going back up and house prices going to the moon. Again. Everything, everywhere, everyone, property. Far out, man. That's not what I wanted. That is not what the RBA's mission would be. They'll be like, oops, did not want that.
Yeah, but there is a lot of pent-up demand, I think, while rates were so restrictive. And then there's a lot of people also, and this is something we might talk about in a bit, predicting or thinking that, okay, we're going to get further easing over the next kind of, year or the next 6 months or the next 3 months, whatever it may be. So everyone's thinking, cool, if I need to get in now, basically before there's further rate cuts, further asset like appreciation. So I think that drives a lot of it, that kind of FOMO that you're on the start of the easing cycle. So like jump in now.
Yeah, that sounds like some of the messages we've been saying out loud. So yeah, it makes sense. Everything, everywhere, everyone. Property boom. I love saying that out loud. It's just so much fun to say out loud, especially because there's periods, we've been doing this podcast for like 3 years now, and there's periods where it's just like, it sucks.
Yeah.
It's nasty. And it's been a little bit like that for periods of the 3-year journey that we've been podcasting. But yeah, now it is very much party season. And you see that in some of the data. So let's talk about theme number 2. This rate cutting cycle has created a reboom. And this reboom has been everywhere in every single capital city. It's a macro boom. It's not a micro boom. But then as it's played out for a little bit longer, so, we're at the end of the year now. Now that the boom has played out for a little bit longer, you can now see the players that are, being like, I'm going to soar ahead into 2026. And those that are closer to their sort of fair valuation, in and around there, they're slowing back down. And those that are not as close to their fair valuation, they're just like, nope, it's time for me to, increase in value rapidly and move towards the valuation that my housing value should be at. It's probably a little bit too economicsy how I explained it, but, Perth, Brisbane, Adelaide are soaring again. Sydney and Melbourne have sort of slowed down a little bit again as well towards the back end of the year after rising quite materially for a few months in the middle of the year after those rate cutting cycles, at least relative to where they were.
Yeah, I think we've spoken about this and to kind of cut this up a number of different ways on previous podcasts as well. But the way I would kind of describe it is the markets that the growth is being driven by a reduction in interest rates, basically. So cost of debt's going down. Supply and demand dynamics maybe aren't that out of whack, but we're just kind of reducing the cost of debt. That increases demand, prices go up as a result of that. So I'm thinking like Sydney, Melbourne markets, like affordability, particularly in Sydney, already a little bit stretched. So there's not the fundamental drivers that like, hey, if nothing happened, you're going to get 10% price growth in these markets just by itself. It's kind of like it's getting a push. It's getting some winds behind it that are pushing it forward. Those markets, maybe there's a bit less in going forward because the interest rate story might be more stable than easing. But like you say, then there are some other markets where there's really, really strong economic performance. There's migration coming in. There's other factors that are pushing demand up outside of any changes in interest rates, any changes in anything else.
Let's go through that. So that makes sense. Sydney, Melbourne getting a little bit of a push. Sydney in particular are very, very expensive at the moment. So quite hard to afford, quite hard for house prices to grow, to the moon at the moment when prices are at this level and interest rates are at this level. It will continue to accelerate, especially if interest rates come down over the next 3, 4, 5 years, but its current valuation sort of matches where it should be. Melbourne's probably got a little bit of room to run. But let's go through this reboom in Perth, Adelaide and Brisbane and Darwin and even Hobart now, like the other markets. That's happening now. It's pretty obvious. The pace of growth is now getting faster and faster. It's getting absurd in some markets. In Darwin, it's at 2%. In Perth, it's 2.4%. In Adelaide, it's up well past 1.5% now. Brisbane as well. Like this is rapid growth rates that are happening on the ground. So we are in the middle of booms in these cities. Like it's just objective. Like, when prices grow at 20% per annum, it's boom time, like proper boom, as much as you can get it.
Yeah.
That's happening across like 5 capitals, 5 of the 7 or 8 capitals at the moment. And Hobart's been included in there. Hobart was sleeping for a long time. Now it's like, no, I want to join the party. What's going on?
Yeah. To be honest, it's hard to actually pin down one particular answer, I would say. Like from my perspective, like I think the yields story has a little bit to do with it. Like I think a lot of the growth or like a lot of the activity is investor led at the moment rather than owner occupier. That's probably like I think one of the trends of 2025 that we've seen.
Brisbane and Adelaide yields suck.
True, yeah. And like I think that's part of the story with Hobart is like the yields are a bit healthier there.
Yep.
Perth maybe to some extent as well.
Yep. Darwin for sure.
Yeah, Darwin for sure. And like, yeah, for investors, particularly if the cash rate's not changing, like some of the yields in other capitals are really, really low and the cash flow burns really, really high. So the cost of acquiring 3 or 4 properties at very low yields is, expensive month to month. So I think that's part of the reason why some of these other markets get the spotlight, and get some of that investor activity. But I don't think it's entirely one reason, because like you say, Adelaide, the yields aren't there, Brisbane, the yields aren't there, and they're going through that very same upswing.
For sure. Kurt, how much do you think Darwin's increased this year?
Off the top of my head, I don't know, 35%?
Whoa!
30? We talk about it a lot. Like on the ground, I wouldn't be surprised.
So a year ago, I checked this out yesterday. A year ago, we sat in this very room and we're going through a boom and bust report, which has just come out again. And we've done a couple episodes on the YouTube channel if you want to go through our 2026 predictions.
Darwin houses, maybe?
And how we've gone through it. Yeah, I think on the ground, many suburbs have gone up that much.
Yeah.
But on that report, I think they had about 6% for Darwin. And I said that, hey, they're off. All of these are pretty close, but Darwin's off by 3 times. It'll rise by more than 18. I think I said 20%. Like you can almost bank on it. So that's happened now. And like Darwin, actual median house values, the aggregate data, it's always a little bit less than
lags.
Individual house data.
And units are like, there's not, everything doesn't grow at the same speed.
Exactly, right? And it lags at this rate of growth. It probably has gone up 35%. It's just the data's going to catch up over the next 6 months. It's up 20% in a single year after a 10-year period where it was down 15% in absolute values, or 6% in absolute values since 2014, and now it's just shot up 20%. So absolutely wild story. The reason why I bring that up is there's a lesson in that. There's something that's happening here. Like it's a macro boom, but it's also placed. Now I think next year, let's say it out loud. Let's recharacterize it already. This everything, everywhere, everyone property boom, I'm going to call it here. It's over. That's finished. The characterization is no longer fair. We are talking about the story of 2025, but we are moving into 2026. And we're going to do another episode on all the themes that we think is going to happen in 2026 very, very soon. The everything, everywhere, everyone property boom, 2025 story. 2026, it's now moving back to that sort of, it's targeted booms. It's specific locations. It's specific regions. It's specific reasons for it too. And I want to touch on the underlying reasons for some of this. And my pickup is that a big theme of 2025 has been population has dragged back. We don't talk about it enough, because we're still in the narrative of 2024. But the population growth rate story has dragged dramatically back. Like we had close to 650, 700,000 people 2 years ago, at the peak. There was catch up. And now it's down to this year that we're in, it's going to be about 390,000. So it's been dragged so far, pulled down, and it's back to the 2016 sort of level, the level that it's supposed to be. It hasn't really risen that much from it. Now, that's the underlying demand story for housing, population growth. The reason why some of this growth is happening is because where this population is going is it's going in the biggest housing shortages now. It's not going to the markets that have the excess capacity. It's going to the markets that are already flying. But the ones with the housing shortages happen to be smaller cities. They're not the biggest cities. They're not Sydney and Melbourne with the biggest housing shortages. We might feel it as a population, but Adelaide's got a bigger housing shortage than Sydney. Perth does too. And Brisbane does too. Brisbane's got a chronic one, especially in the apartment market. And that's where that's where the population growth story is. It's in these 3 capitals.
Yeah. And I think, that combination, that gets you those targeted booms, I guess, where if you've got somewhere that's chronically undersupplied, or even just a smaller market, right? Because if you, just as statistically, if you're adding 1 person into a 100,000 person city, that's a bigger percentage change in demand than if you're adding it into a 1 million person city, right?
100%.
So, where the immigration flows and where the population growth flows, if it's into smaller markets, it has a much bigger effect than if you're doing it in Sydney or Melbourne, which are, 6 million, 7 million people. Changing 50,000, 100,000 is a lot, but much smaller percentage change relative to the big market than if you're doing it somewhere like Darwin. Much smaller population, you're adding 50,000 people there. That's a drastic change.
100%. I think I'm going to add one more thing here. So when you frame this 2025 story where it's just like, hey, look, everything has just gone up. Wind is flying in the right direction for property investors everywhere. Investor credit growth, 12% at the moment. It's flying at the moment. One of the changes that happen here, and that's happening right now, is that's kind of slowed down a little bit because the interest rate story is no longer cutting into 2026. Everyone's just like, no, that might not happen anymore. We expect interest rates to stay the same, maybe even go up. So that change in the macro environment means the wind has stopped.
Yeah.
So now it's the cities that are justifiably going to increase that are continually going to increase now. Like you got to have a reason for it to have these crazy growth rates in these markets. And that reason is the underlying housing shortage that exists at the moment.
Housing shortage, population growth, and maybe to some extent, your local economic performance. Yeah.
Exactly. Right. So that's why if you go on our YouTube channel, it's coming out step by step. Like that's why we've kind of refocused the discussion a little bit where we are looking under the hood into specific markets at the moment. I've just released Geelong and I've gone through the economic engine room of Geelong and we've just called it out being like, I went through it and I did it live while I was doing it. I was just like, look, I'm not going to have a preconceived idea of whether you should invest in Geelong or not, but let's go through it step by step. Let's get two Treasury economists because you did it first as well. You did it with me, right? I mean, I delivered it, but I got your take on it as well. Let's get two Treasury economists to look at how an individual economy is actually performing step by step, then flow it through into the suburb selections and the property selection process as well. Because obviously we're together and all the transactions that we've done, we've seen thousands of property deals. And me personally, I've probably done 50 of them already as well. So, we can see value and hunt deals pretty well now. So you combine that process, you can start looking with a magnifying glass. And that's the approach you got to take now. It's not the same as you just throw a dart anywhere in Australia and it's going to make you fly. Now you need a magnifying glass into 2026. This is a big kind of shift. And with that magnifying glass, you need to start looking at the right factors that really drive market performance in the medium term rather than the right now. Because as we've just touched on, through 2025, the right now can change in the same year. Like it's already shifted. We've had multiple. We began the year, no rate cuts. Then rate cuts came in. Melbourne started flying. Sydney started doing really well. Everything, everywhere, everyone, property boom. Now that's over. Now it's back to the magnifying glass. That's kind of what I'm trying to get to. So if you want to understand the city by city of exactly where you want to invest, I'm going to do this about a dozen times. We've released Geelong, Launceston's coming, and I'm going to do pretty much every market that I think deserves that magnifying glass. And look, then at the end of it, I'll rank it all out for you. And it really just gives you a proper analysis of exactly where you want to be investing, why, and the beige flags of each city as well. So that's on our YouTube channel. Go check it out if you haven't already.
Yeah, not to plug it more than you already have, but the reason why that's super useful is the framework for analyzing these locations is like repeatable, right? So even if where you're looking at isn't on the list of the ones that Reedham covers, the way to go through the data metrics, the different sections of the economy, the framework to analyze it is kind of laid out there for you. So you can take that framework and then pick any location that you're interested in and go through those same metrics, go through that same process with it to get a better feel for it. So we're doing those ones, but keep in mind that you can take that framework and run with it.
Yep, for sure. I'm going to touch on some final themes. I'm just going to put this in the other category, but it does really impact property markets, at least in different cities. And it's not just macro factors. It is sort of micro isolated factors as well. So government policy changes. There's been a big crackdown on universities and the flow of students into Australia that has slowed and pulled back economic activity. In some markets specifically as well, that has specific impacts and impacts the type of homes that we need as well. So that's one change that's slowed the economy down, probably at the wrong time, but it has slowed the economy down. Students happen to be our third biggest export in Australia as well. After iron ore and coal, it is students. So we've pulled back the student part because of the housing issues and, popular demand. We've slowed that down. That's impacted housing. We've had big efforts in house planning activity. And this is, I'll touch on a different episode, but this I think is huge. We just don't even know it yet. But the whole narrative over the next 5 years, I think it could shift to we are building a lot of homes. I think it's going to change. I'm probably going to be one of the very few people that say the measurement of performance on our housing construction is going to rapidly improve within about 12 to 18 months. We just don't even know it yet, but all of the changes that happen this year are going to drive that activity. My little spidey sense as to why I know this is on 2 development sites that I'm working on. I've gone from 4 homes to about 150. Like I've got a development site with 110 homes on it. You could probably put 4 on it. Now it's 110. I've got another one where there's a single home and it's 14 apartments. And all my developer friends, everyone in my circles, my WhatsApp, my planners, all of my contacts are just telling me it's going wild in this space. Hasn't been like this for a long time. And the number of new additional dwellings is like enormous. And, we're not stupid. I don't go do planning approvals for things that won't get built because why would I do that? That doesn't make any sense at all. It costs me hundreds of thousands of dollars to get these planning approvals. I make sure my fees don't make sense and it's going to be built. So if we go through the process of actually doing it, then it's still like the completion ratios are still likely to continue. But there's a huge uptick in approvals coming at some point in 2026, probably in the back half because it takes so long to get approvals through council. So that's another big theme. The economic themes of unemployment rising and that trend has changed is pretty important, particularly in Sydney and Melbourne, and the composition of jobs changing is starting to happen as well. So
participation rate falling as well. It's not that rosy of a picture in the employment side, I would say.
Yeah. And the big slack and like the tightness is coming off. Now it's like a little bit like, hey, what's happening every month? Like, do employees need people? How's it going?
People are shifting from full-time to part-time or like working less hours, participation rates falling, less people in the workforce. So in my view, this is one of the annoying parts about the employment statistics is the numbers get padded out a little bit when there's an easing because like these factors mean the headline rate doesn't always make it seem as bad as it is or doesn't really show the full effect of what's happening if you only look at the like headline national figure.
100%. That's why in our economics videos, I go through it in detail. This is how I do job stories. I do the unemployment rate. I do employment growth. I do the youth unemployment rate change over 12 months. I do the breakdown of individual sectors and the composition change of which jobs are moving between cities. And then I look at lead data, like online job advertisements in that particular location. And I break it down by region. I'm like, how many people in Geelong are literally going and putting Seek ads right now? And how has that changed? It tells me what the job story is going to look like in the next 12, 24 months. And that's the sort of analysis you need to. You can't just look at the unemployment rate like, that just doesn't work. Like it's not good enough. You can't just singular measure it. That doesn't work. You need to look at it contextually. So some of that's there. Yeah, so those are the key themes as well. You've got a budget as well, like the federal government is in the middle of its cycle as well. There's probably increasing momentum. I think this one's worth touching on in 2025. There's probably increasing momentum for change in housing policies as well. I feel like that momentum is building to something. Those conversations have been dialed up a little bit for where it is in the political cycle as well. So another potential thing to be mindful of for property investors. That's kind of my takeout for some of the key themes there. And the Australian economy is just sort of meandering along, not doing that great, sitting at 4 or 5 out of 10 and just moving along. It hasn't been the greatest year for Australia as a whole.
Yeah.
Is that fair to say?
Yeah, I think that's fair. My kind of takeout is I personally think that 2025 was a pretty good year to make acquisitions. And I think 2026 is going to be more difficult, I would say. So hopefully the people listening to this podcast have taken the kind of baton and ran with it while the sun was shining. There's always opportunities, but my gut feel is that, for the kind of once rates cut, the March to September kind of 6-month window in the middle of the year was a really, really good time to expand your portfolio, acquire. It was easy to get debt. Though some of those things are going to be a little bit trickier going into 2026, I think, on a few different fronts.
Yeah, for sure. And I'm going to wrap it up there. In the next episode, we're going to go through 2026 and really unpack some of the things we just touched on here. What's going to change, how the lending market is changing, and why investor movement and activity is going to adjust with these lending changes, and how you can prepare for it for 2026.